Picture this. Two college roommates graduate with identical business degrees, land jobs at the same company making exactly $75,000 a year, and move to the same city with the same cost of living. Fast forward 20 years later, and one of them is sipping margaritas on a beach in retirement, while the other is still grinding away at the office, wondering where all their money went. How does this happen? How do two people with identical starting points end up in completely different financial universes? The answer might surprise you, and it definitely goes way deeper than just luck or some secret investment strategy that only rich people know about. My name is Nick, and I help people understand the psychology and mechanics behind building real wealth. If you're tired of wondering why your bank account never seems to grow despite making decent money, make sure to subscribe to the channel and hit that like button if this video helps you figure out where you've been going wrong. Here's something that's going to blow your mind. According to recent studies, 1/3 of people earning over $200,000 per year report living paycheck to paycheck. Let me repeat that because it sounds absolutely insane. People making $200,000 a year, roughly $16,000 per month, are struggling financially just like someone making minimum wage. Now, if you're sitting there making $50,000 a year and barely scraping by, you might be thinking these high earners are just terrible with money. And honestly, you'd be partially right. But here's the thing that's really fascinating about this whole situation. The habits and mindsets that keep someone broke at $200,000 are exactly the same ones that keep someone broke at $50,000. The numbers are just bigger. Think about it this way. If you're bad at managing $1,000, you're probably going to be bad at managing $10,000. Money doesn't magically make you smarter about money. In fact, it often does the opposite because it gives you a false sense of security that leads to even worse financial decisions. So, what are these mysterious habits that separate the financially successful from the financially struggling? Why do some people seem to effortlessly build wealth while others can't save a dime no matter how much they earn? The answer lies in three critical areas that most people completely mess up, and three fundamental habits that wealthy people have mastered. Let's start with the mistakes that keep people broke, because recognizing these patterns in your own life is the first step toward changing them. And trust me, you're probably going to see yourself in at least one of these examples. The first wealth killer is something called lifestyle inflation, and it's probably the sneakiest trap in personal finance. Here's how it works. You get a raise at work, maybe from $50,000 to $60,000. Suddenly, you've got an extra $850 per month after taxes. That feels like a lot of money, right? So you upgrade your apartment, lease a nicer car, start eating out more often, maybe pick up a few new subscriptions. Within a few months, that extra money has completely disappeared into your new lifestyle, and you're back to living paycheck to paycheck. Except now, you're doing it at a higher income level, which somehow feels even more frustrating than before. The crazy part is that this cycle repeats itself at every income level. The person making $30,000 dreams about making $50,000, thinking all their problems will disappear. The person making $50,000 is convinced that $75,000 is the magic number, and the person making $75,000 is certain that once they hit six figures, they'll finally have their act together financially. But here's what actually happens. Each time their income increases, their spending increases right along with it. They never actually get ahead because they're constantly upgrading their lifestyle to match their new salary. It's like being on a treadmill that keeps speeding up. You're running faster and faster, but you're not actually getting anywhere. I know someone who went from making $40,000 to making $120,000 over the course of 5 years. Sounds like a success story, right? Except they're more stressed about money now than they were when they were making $40,000. Why? Because instead of living like someone who makes $40,000 and banking the difference, they immediately upgraded to living like someone who makes $120,000. New car payment, bigger apartment, expensive gym membership, designer clothes, frequent vacations. Now they're trapped in what I call the golden handcuffs. They can't afford to take any risks with their career because they need that high income just to maintain their lifestyle. one missed paycheck, and their whole financial house of cards comes tumbling down. Compare that to someone who gets the same raises but keeps their lifestyle relatively modest. Maybe they upgrade a few things here and there, but they're intentional about it. They're not trying to look like they make six figures. They're trying to become financially independent. That person is banking $60,000 or $70,000 per year in the difference between their income and their expenses. Within a few years, they have enough saved and invested to take real risks, pursue their passions, or even retire early if they want to. The second mistake that keeps people broke is debt. And I'm not just talking about credit cards, although those are definitely a problem. I'm talking about the entire debt lifestyle that so many people fall into without even realizing it. Here's a typical scenario. Someone makes $75,000 per year, which sounds pretty good on paper, but they've got a $400 car payment, $200 in minimum credit card payments, a student loan payment, maybe a personal loan they took out for some emergency a few years back. Before they even think about saving or investing, they're sending over $800 per month to various lenders. Now, let's compare that to someone with the exact same income who has zero debt. That debt-free person has an extra $800 every single month to save, invest, or use for opportunities. Over the course of a year, that's almost $10,000 of additional financial flexibility. But it gets worse than just the monthly payments. Debt fundamentally changes how you think about money and opportunity. When you're carrying debt, especially high-interest debt like credit cards, every financial decision becomes about managing that debt rather than building wealth. You can't take advantage of investment opportunities because you're too busy paying interest to credit card companies. Let me give you a concrete example. Two people both get a $5,000 bonus at work. Person A has credit card debt at 20% interest. Person B has no debt. Person A uses the bonus to pay down their credit cards, which is the smart move, but they're essentially getting a guaranteed 20% return just to get back to zero. Person B takes that same $5,000 and invests it in the stock market. Fast forward 10 years, person A is hopefully debt-free by now, but they have nothing to show for that bonus except the relief of not owing money anymore. Person B's $5,000 investment has potentially grown to over $10,000, assuming average market returns, same bonus, same income, completely different outcomes based on their starting financial position. This is why debt is so insidious. It doesn't just cost you money in interest payments, it costs you opportunity, it costs you time, and it costs you the psychological freedom that comes with knowing you don't owe anyone anything. The third mistake is probably the most common, and it's something that affects people at every income level. It's the complete lack of financial awareness. Like, most people have absolutely no idea where their money goes each month. They know how much they make, they know how much their rent costs, but everything else is just a blur of transactions and swipe decisions. I've met people making six figures who couldn't tell you how much they spent on food last month. They've got no clue what they're paying for subscriptions, how much they're spending on entertainment, or whether they're actually saving any money at all. They're flying blind financially, making decisions based on how much money happens to be in their checking account at any given moment. This lack of awareness leads to what I call death by 1,000 cuts. No single purchase seems significant enough to worry about. $5 for coffee, $15 for lunch, $30 for that thing on Amazon, $50 for dinner out. Each transaction feels small and manageable, but they add up to thousands of dollars per month in unconscious spending. Meanwhile, the person who tracks their expenses knows exactly where every dollar goes. They're making conscious decisions about their spending, and they can quickly identify areas where they're wasting money. This awareness alone can free up hundreds or even thousands of dollars per month for saving and investing. The difference between these two approaches might seem subtle, but the psychological impact is enormous. When you're aware of your spending patterns, you start making what I call friction decisions instead of flow decisions. A flow decision is when you just go with whatever feels right in the moment. A friction decision is when you pause and actually think about whether this purchase aligns with your financial goals. Here's where it gets really interesting though. These three mistakes I just described aren't really about money at all. They're about psychology, and that's where we start to see why two people with identical incomes can end up in completely different financial situations. Like, the person who falls into these traps usually has what psychologists call a scarcity mindset. They're constantly worried about missing out, whether that's on experiences, possessions, or social status. This fear of missing out drives them to make emotional spending decisions that feel good in the moment, but destroy their long-term financial prospects. They see money as something that flows through their life rather than something they can accumulate and control. When they get extra money, their first instinct is to spend it before something bad happens or before they talk themselves out of whatever they want to buy. It's like they don't trust themselves to hold on to money, so they get rid of it as quickly as possible. On the flip side, let's talk about the habits that actually create wealth, because this is where the magic happens. The people who build substantial wealth despite average incomes have figured out three fundamental principles that completely change how money works in their lives. The first principle is what I call time arbitrage. Wealthy people understand that money today is worth dramatically more than money tomorrow, not because of inflation, but because of compound growth. They're essentially borrowing from their future selves by investing early and consistently. Let me show you how powerful this really is with a story that'll make you want to travel back in time and slap your younger self. Meet Sarah and Jessica, both 25 years old, both making $75,000 per year. Sarah decides to invest $3,000 annually for just 10 years, from age 25 to 35. After that, she never invests another penny. Jessica, meanwhile, spends her 20s living it up, traveling, buying designer handbags, the whole 9 yards. But at 35, Jessica has an awakening. She realizes she needs to get serious about her future and starts investing $6,000 per year, double what Sarah was putting in. Jessica keeps this up for 30 years straight until she's 65. Here's the plot twist that breaks people's brains. Despite investing for only 10 years compared to Jessica's 30 years, and despite investing half as much annually, Sarah ends up with more money at retirement. Sarah's total contributions were $30,000. Jessica's were $180,000. Yet Sarah's account balance is higher because she gave compound interest an extra 10 years to work its magic. This isn't some theoretical example with unrealistic returns. This is basic mathematics using average stock market returns over time. The person who understands this principle and acts on it in their 20s will build more wealth than someone who waits until their 40s, even if the late starter has a much higher income. But here's what's really fascinating about this. Most people know this information intellectually, but they still don't act on it. Why? Because investing $3,000 when you're 25 feels like a massive sacrifice. You're giving up vacations, nice dinners, clothes, whatever makes you feel good right now. The benefit feels abstract and far away. Meanwhile, starting to invest at 35 feels easier because you're more established in your career and hopefully more mature about delayed gratification. But by then, you've missed the most valuable years for compound growth. It's like showing up to a party after all the good conversations have already happened. The second wealth building habit is something I call paying yourself first, and it's probably the most important financial concept you'll ever learn. Most people approach their money backwards. They pay all their bills, buy whatever they want or need, and then save whatever's left over at the end of the month. Spoiler alert, there's usually nothing left over. Wealthy people flip this equation completely. The moment money hits their account, they immediately move a predetermined percentage into savings and investments. They pay their future self before they pay anyone else, including their current self. Only after they've secured their financial future do they figure out how to live on what remains. This might sound like a minor change in approach, but it creates a completely different relationship with money. When you pay yourself first, you're forced to be creative about your spending. You can't just drift through the month buying whatever catches your eye because you've already committed that money to your future. Let's say you make $5,000 per month after taxes. If you pay yourself first, you might immediately transfer $1,000 to investments and savings. Now you have $4,000 to work with for the rest of the month. You'll find ways to make that $4,000 cover everything you need because you have to. Compare that to someone who plans to save whatever's left over. They start the month with $5,000 available for spending. They buy groceries, pay bills, grab lunch with friends, order something online, pay for streaming services, and before they know it, the month is over and they've spent $4,900. They save $100 and feel good about it, not realizing they just chose short-term comfort over long-term financial freedom. The beautiful thing about paying yourself first is that it removes the willpower component from saving. You're not constantly making decisions about whether you can afford to save money this month. The decision is made automatically and your lifestyle adapts accordingly. The third habit that separates wealthy people from everyone else is their focus on assets versus liabilities. Now, I know this sounds like boring accounting terminology, but stick with me because this concept will change how you think about every purchase for the rest of your life. An asset puts money in your pocket over time. A liability takes money out of your pocket over time. Wealthy people obsess over acquiring assets and minimizing liabilities. Everyone else does the opposite without even realizing it. Here's a perfect example. Two people both decide they need better transportation. Person A buys a brand new car for $40,000 with a loan. They've got a monthly payment, insurance costs, maintenance, and the car is losing value every single day. This is a liability disguised as a necessity. Person B buys a reliable used car for $10,000 in cash. But here's the key difference. They take the monthly payment they would have had and invest it instead. Let's say that would have been $600 per month. Over 7 years, instead of making car payments, they're building an investment portfolio. By the time person A has paid off their car loan, they own a 7-year-old vehicle worth maybe $15,000 if they're lucky. Person B owns a 7-year-old vehicle worth maybe $4,000, but they also have over $60,000 in investments that are continuing to grow. Same transportation need, same monthly cash flow, completely different financial outcomes. One person focused on looking successful, the other focused on becoming successful. This mindset shift around assets and liabilities becomes almost addictive once you understand it. Wealthy people start seeing everything through this lens. When they're considering a purchase, they ask themselves, is this going to make me money or cost me money over time? And if it's going to cost them money, they ask, is this cost worth it? Or could I put this money towards something that actually grows my wealth? Let me give you another example that'll probably hit close to home. Two friends both love technology and want to upgrade their home entertainment setup. Friend A drops $3,000 on a massive 75-inch TV with all the latest features. It's gorgeous. Everyone who visits is impressed, and it definitely makes watching Netflix more enjoyable. But 5 years later, that TV is worth maybe $800 if they're lucky. Friend B takes the same $3,000 and buys shares in the companies that actually make the TVs, the streaming services, and the content everyone's watching. 5 years later, assuming average market returns, that $3,000 could be worth over $4,000. Plus, they've been collecting dividends along the way. Now, I'm not saying you should never buy a TV or that you have to live like a monk to build wealth. The point is that wealthy people are conscious about these decisions. Maybe friend B waits 6 months, finds a great deal on a smaller TV for $800 and invests the remaining $2,200. They still get to enjoy their shows, but they've also made a choice that builds their wealth instead of depleting it. Here's where it gets really interesting though. These habits create what I call a wealth feedback loop. The more assets you accumulate, the more income those assets generate, which gives you more money to buy additional assets. It starts slowly, but it accelerates over time in ways that most people find hard to believe. So there you have it. The difference between ending up rich or broke isn't about your salary, your background, or some secret knowledge that wealthy people hoard like dragons guarding treasure. It's about three simple choices: avoiding lifestyle inflation, staying debt free, and being intentional with your money. The person sipping margaritas on the beach didn't get lucky, they just made different decisions with the same opportunities you have right now. Your future self is counting on what you do today,